Hi, everybody. This is Brian Manco again. As you know, I'm a CPA in public practice. I'm here with the Rocky View Entrepreneur Series, and what I'm doing is trying to promote businesses locally. Everyone within my practice here is local. I'd like to introduce Mike Collombin, he's an insurance specialist, and he's someone who's helped me tremendously as well with my insurance needs. I wanted everyone to know how some of his products could help with your businesses as well. So, Mike, I view Mike as an extension of my practice. As you know, I'm a one-man show, and I don't really know or how I would help you with insurance, but Mike can. So, with that, why don't I introduce Mike? Welcome, Mike.
Hi, Brian. Good morning. How are you?
I'm doing good, and how about you?
I'm well, thanks. And certainly we're an extension of each other's business because I'm not an accountant and I'm really bad at math, but I can find the answers. So, yeah.
Yeah. Well, how Mike and I met is like, well, we know each other personally, of course, but as well, Mike helped me with some life insurance. But along the way, I learned all the other different things that Mike can help with the types of products that he's got that can help with corporations as well. So I'm not sure where to start. I mean, Mike, you mentioned the four key pillars of insurance, and um, why don't I just let you start with the view that most people watching this are going to be my entrepreneurs that are working with me. So,
Right. Well, I think typically in my mind, I split it into two parts. There's the personal estate planning side of things, and then there's the corporate issues and business matters that come up. I work both in, back and forth between the two, and obviously in a small business privately held, they're interchangeably and intertwined for the business owners. Absolutely. Four key areas: financial planning, and your industry helps them with the planning and the filing and keep them on track, and recording and reporting. But where we sit on this side of the desk, it's death, disability, retirement, and liquidity. What if you do die? What do you need to have happen, and what are the steps, and for who, and for what, and for why? If you're disabled, that's your biggest earning power. I mean, the individual ability to earn an income is paramount, especially when you're starting out in the younger ages, to realize that. So most people have disability coverage through their employer, which is the other side of our business, is setting up health and dental and disability life insurance programs for employees and employers. And then retirement money for later, and however you're going to do that in a multitude of different ways. And I think that old analogy of not all your eggs in one basket is crucial, and insurance can be one of those and plays a big role in it. And that also ties into liquidity, which is access to cash, whether it's buy a new fridge or put a roof on the house, or a new car, or you send the kids to school, or buy out your partner that you no longer work with. So those are the kind of the key things.
yeah, that's nice to be able to have the liquidity. There's like you were just saying, be able to buy out a partner, have money, put your money in, be able to use it in different ways. No, that's great. Um, One of the things that I'm asked question a lot of is like, how do I, and farmers ask this question a lot, and other business owners, how do I transfer this asset that I've got to my kids, and how do we handle the capital gain? And that's one area where insurance can come in, right?
Right. For sure. I'm not a farm tax expert, and there are, unique circumstances that you know about far more than me. But I think what's consistent there is the planning opportunities when as you just said or asked, was between corporation and personal estate. And what's often overlooked is that you can use insurance in your corporation to fund a buy sell between your partners. Often the partners will have a piece of paper, the big 28-page document in there filed somewhere with dust on it that says, yes, we've got a buy sell agreement, but is it funded? Did you purchase insurance to cover each other off? And that's the simple side of it. And then the more complex and opportunity is that you can build cash and equity in insurance products on a tax-free basis. It's also 100% guaranteed collateral, depending on the product, but a large percentage of it, at the very least, is fully securable collateral, which creates its own opportunities. And it's tax advantage. It can grow tax free. So the only other things I know of is an RRSP or a TFSA that can do that. So if you can shelter money, grow money, build an asset while covering yourself at the same time in the corporation, you can move an asset in and out of the corporation. So both sides of the street, you can move that asset from a personally held into the company, and you can move it from the company out to yourself. The biggest thing with equality comes up is, fair versus equal, and you can use insurance to do that. So if one sibling or one partner is going to take over the business that you worked hard to build, and the other sibling or partner or family or charity is going to get cash, you can equalize that again using insurance. There's so many different ways to wrap it, market it, package it. They're all called different things. Every insurance company has different ways of tax preferred this and asset transfer that, and different nicknames and marketing slogans and so on. But it's a tax-free asset, both on the payout of the insurance and within the equity that you can build in a policy as well.
Brilliant. That's worth saying again. You can pay money into an RSP, but if you select the right product that you need for whatever it is your needs are, you can build your money tax free and have an asset that you can use. That is, I think a lot of people are beginning to consider, or I've heard of a lot of people are beginning to consider insurance products such as this. The wide variety that you have, as not having your eggs all in one basket in an RSP. So, do you rely on the stock market at the end of the day when all of us need our money whenever the end is? What's the stock market like? Whereas,
right.
things are a little bit more secure in insurance products.
Well, it's all the above, right? I mean, you got to do a bit of everything, in my opinion. And there's no one cure-all financial product or investment that's going to meet all your needs. But it's that blend, and what insurance, speaking to that, can offer is long-term stability, and that's certainly on the participating permanent side. And if you want to be able to turn all the dials yourself and manage the investment side of it and the cash components yourself, then you can do it more with a universal life type product. So each his own on how you want to do it, but there is definitely stability within the financial products. And the companies, for the most part, have been around 100 years. The Canada Life, Manulife's, Great West, London Life's, and emerged now, but Sun Life's and all the big players have been around for so long that you can look at their track record and see the long-term stability for the financial products. And those that have folded, and those are far and few between, they're all backed by the others. So everybody's secure in that world.
That sounds great. So majority of my clients are, have employees of maybe 1 to 50 people. What are some common things that let's just think of some scenarios of I don't know, just considering people that have maybe 1 employee to 50. What kinds of things would suit them?
Right. I mean, from 50 down, typically is what we see is that's that threshold where they have to build up a big human resource department to help them manage their company from 50 on. And under 50 certainly is where our expertise and hands-on is more intertwined. You've got the corporate side, which includes your group benefits, health, dental, disability, life insurance for all your employees. You might have partners in the company, and then we fund their buy sell, and it can be a bunch of term insurance. So if somebody dies, they've got to look at what if they die, what if they become disabled, and how are they going to buy out, and the disability buyout of the partner that's no longer working and is sitting on a chair somewhere not feeling so great and able to work, and you've got to replace them, and you've got to come up with the capital to replace them. So you might want to fund that buyout, let's say 2 years later, and say, thanks for all your time and service, but if you can't return to work, and we're going to have to move on. So that costs capital. And then, liquidity buyout. If you want to retire from your business one point down the road and bring in a junior or new partner or senior partner, and it does work well with the accounting firms, very well that there's a succession there, and you can leverage it out of the existing policies on the senior partners to come up with the equity for the buy-in for the junior partners. You insure them, you move them forward, and so on and so on, and you can leapfrog the policies. So there's that within smaller companies, and then those discussions then sidestep to sitting around the breakfast table, so to speak, in terms of their own estate and personal needs within their own households and the business owner, and what do they want to do, if at all, for the kids or the grandkids or the great grandkids or the charity. And one of the things that comes up on that side when I say, do you want insurance or do you need insurance, is when people are young, buy all the insurance you can. You can load up on term insurance, prove insurability, do it cheap, and buy all the coverage and more than you're ever going to need. And then over time, chip away at it and convert it into something permanent for later. And why would I want to do that? Is because you can use the insurance company's money instead of your own. So the most successful people, highest worth, own the most amount of insurance, and that one's got to sink in for a moment. But that's the reality of it, and they don't need it. It's because they want it. And my simple math is, if you've got or wish to leave $1 million on the table, or need to, if you've got $1 million tax liability to wind up your estate and your net worth is 6 million, you can write a check, but the estate can write the check. But the opportunity is if you've got to pay off $1 million, or you want to leave $1 million to the kids or to your great grandkids, and it costs you $600,000 to do it in excessive insurance premiums that they charge you through the nose, you just freed up $400,000 by my math that you could spend before you died and leave the piece of paper for $1 million on the table for later. So you can free up your own capital by having that piece of paper filed away in a drawer somewhere that says, here's a tax-free payout of $1 million. And so that's not a, I don't need it. That's an opportunity. Have I got a deal for you? You need to or wish to leave $1 million tax-free. Here's how we're going to do it. You're going to pay $600,000 in total premiums. They're going to pay out $1 million, and you're going to go spend $400,000 on everybody that you want to enjoy it with, or yourself, earlier. So oversimplistic, absolutely. And you can tell me what the daily dollar cost average of that is, or the true dollar value of everything I just tried to say. But in simple terms, it's those types of planning opportunities are there with those products.
Yeah. Oh, that works for me, because you just make your monthly payments, put some money in originally, or however it works, and then you've got the coverage as well. Like for me, contributing to my RSP month after month after month, well, that's going to pay off in the end. But if something happens tomorrow, I'm only going to have what I've only put in, whereas the whole policy, yeah, that's
that's right. I mean, that discussion jumps over to disability. Your ability to put money away, whether it's pay the mortgage, make it to an RSP, or into a TFSA, or into your side fund investment account, and put the money to your broker and let them try and earn a greater risk, a higher rate of return. You need to have the cash flow to do that. And as long as you're working, things are great. Disability provides the cash flow into the household, or in a corporate situation, pays for the buyout, and funds the buyout of lump sum capital or business overhead. So the fixed op costs of a company, just turning the lights on, paying your employees, fax, utilities, and then just the regular daily fixed op costs can be covered with the disability policy as well on the owner. So cover the company, cover yourself. As they say, by all means, take full advantage of your group benefits at work. That's what we put them in place for. And that's why your employer puts them in place. And I think that's often overlooked. It's, especially in Canada, it's a given that some employers are going to provide all these benefits for you. But you got to appreciate what the costs are to the employer of providing that. And it is a big perk. It's a huge benefit, because going and buying your own individual health and dental coverages, and your own disability policies, and your own life insurance policies costs a lot of money. So, the group benefit plans that you get through work are huge value to the employer and the employee. And what I see sitting on the employer side of the table, and both sides of it, is they've got to work together and appreciate each other's on that. So you've got to manage your costs. You can't just run it like a spending account, although that's fine as long as everyone knows that it is set up as a spending account.
Yeah. Oh, it's interesting. I kind of missed that point before as well. The disability insurance in terms of covering operations costs too. Like, I don't know. Somehow, I guess I missed that before. So, anyways, that's what our next step is.
Yeah.
um,
Yeah, we've got lots of pieces of the puzzle to play around with and lots of products, but certainly what I enjoy most is the what ifs. And you and I have had many of these conversations. The what ifs are great. What if and how about and what do you think of? If I don't know, I'm going to go find out, and we've got access to the people and the resources to do it. That's how I try and run my practice. Is throw it at me and see where we go from there.
I think that's a good one because like I learn more about this every time I talk to you, and like there seems to be just more to it. Like in 10 or 15 minutes here, we've gone through a lot of things, but that's just the tip of the iceberg. There's so many different ways you can use this, and you know it it uh, it covers you off, right? Like it's not an expense. It's not wasted money because you can take it out and do other things with it too. So
Yeah, and me personally, and for the business, safe, sound, secure products. That's not my nature at all. None of that is. But that's why I like the products. I tend to steer people in the direction of products that are not going to lose them any money. And as much as possible, I put a guarantee on that by the products on how we structure it. So I really prefer it when the clients are buying products that are fully guaranteed. The premium, the payout, the terms, the conditions, everything about it's guaranteed. You're not going to lose anybody any money. No one's going to lose any money. There's just an upside. So I really, really lean towards products that have a floor, and all it can do is move forward and grow. Even if it stayed the same, sometimes that's better. But not going down, not losing any value is certainly my preference. So I'm showing my cards there. If there's some knowledge of products that we're talking about here, I do have a bias with regards to I do enjoy the guarantees for clients, and I've seen other go the opposite way, and things have not worked out well where other products have been utilized and risks have been taken and not managed properly. There is a downside, and I don't think personally that the insurance products should be used in that way, because I wouldn't want to be calling it insurance. So you know. Build the stable foundation and do it with some good guarantees, and then you can afford to take risk. And I think that's all the better if you can take more risk and have more accept more volatility with your other assets and other investments. That's great, but don't utilize your insurance for that purpose, because I think there's other vehicles clearly that you can do, take advantage of trying to expect a higher rate of return. So insurance is not that vehicle. It's the foundation. It's the long-term, secure, boring, solid investment vehicle, and meeting your estate needs and your corporate needs on the insurance payout. We're all going to die sometime. So how do you want to plan? So
yeah, no, that's very true. And I think the majority of people, in terms of deciding what they're going to do with their money, or how they're going to manage their business, everyone thinks about making money and paying the bills, make money, pay the bills. But there's this other element to it as well. And as you were saying about investing in other kind of risk and speculation, yeah, I mean, why not use something that's going to be there for you for sure, and then you can branch out into, you can take the crazy risk in the stock market if you want, like no, I didn't, I like that.
yeah,
Well, I don't know, Mike.
perfect.
So what do you think? Have we covered anything? Is there anything I haven't asked that you really want people to know about you, or the insurance industry? I mean,
Not me. You don't want to know any more about me. That's not going there.
Mike,
But
the most
no,
conservative guy in
I
investing.
think I think sitting on the insurance desk, and that always being a swear word when I started in the business, and that's 30 years ago somewhat. It's I really think that, well, get as much insurance as you can when you're young and insurable, and start having fun with your sports risks, your occupation and travel, and those are all issues that affect your insurability, and load up on it cheap when you can. And then seriously have discussion about being able to convert that into stuff that will be there for you later. Because truth be that you just look at the financial statements on any of the insurance companies, and term insurance is a really profitable product. And that's what people tend not to realize, is that you're either going to stop paying for it because of the premium increases get so substantial, or you're going to outlive it. And so either way, you're going to cancel it. And statistically, that's the actuaries are smart people, and they run the numbers and they know. And statistically, that's how they're going to make their bucks, is that they're going to insure you, you're going to pay them a lot of premium over the years, and then you're going to cancel the policy. And if you don't, you're going to outlive it. And so that product line favors the insurance company, if you will. Just statistically, that's how it works. That's the math. Other products can favor you and lower your net costs in the long run. But you got to pay to play, and it takes time, and they're boring and conservative. But that's the opportunity. So if and to have that discussion with my 50-ish, 60, 70-year-old clients, and I'm not making this up when they say, hey, I wish we'd spoken about this 20, 30, 40 years ago. And I say, well, I'd like to take you to the next meeting with me, because I'm meeting with a 26-year-old that owns his own business and an entrepreneur and just getting started, and he's loading up on a bunch of term insurance. That's great. But when I'm sitting there with the 65, 70-year-old, he's saying, yeah, well, you better start converting that, because you're not going to like the premiums that we're going to charge you when you're 65, saying, you know what, having some insurance in force for when I'm 90, for various reasons, is probably a good idea. How much is that going to cost? The numbers, a lot. When we just get paid more. So,
Yeah.
you know, take advantage of it for yourself. Start it young.
Well, I think I could have had $1 million life insurance, and just making, on the personal side, life insurance, I could have had that for $50 a month when I was 19 years old. I should have done. Why didn't I? I'm looking back now saying, no, man, that would have been nice. But
Yeah.
for all these other, especially the other products as well.
Well, that's good, because when I was 19, I'm pretty sure nobody would have insured me.
You're going too fast down a mountain or on a water ski.
Something with a ski on it, probably. Yeah.
That's cool.
All right, Brian. Well, as I say, I really appreciate all the what if questions. Keep firing them at us, and those phone calls and emails are always much appreciated, and they're always fun, and what keeps it exciting. So it's great working with the clients and coming up with solutions and different ways to do it, and everybody's story is different. So
okay, will do. Well, great chatting with you, Mike. Thanks for being on the Rocky View Entrepreneur Series, and we'll talk very soon.
that's great. Thanks for the time.
You bet.
Cheers.